Welcome back to the ProTicker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
Good to be here.
This week, the market gave us a really fascinating test.
It really did.
The question was, can surging corporate conviction, real conviction, overpower all this persistent geopolitical instability we're seeing?
And the answer, at least for now, seems to be a pretty firm yes.
A resounding yes, really, but with a big condition.
Provided that conviction is tied to two magic letters.
AI.
Exactly. It was a week that was really defined by capital flows, not just rhetoric. We saw some incredibly strong signals.
Signals that this whole AI infrastructure build-out we've been talking about for months is, well, it's finally turning that excitement into actual multi-billion-dollar commitments.
Real money on the table.
So our mission today is to cut through all that noise and give you the ultimate shortcut to understanding these drivers. We're going to do a deep dive into reports from CNBC, Bloomberg, and Reuters.
And we're focusing squarely on that reignited AI trade, right?
Right. And also the crucial financial earnings that kind of gave the market its stability, plus those underlying geopolitical tensions.
That the bond market just strangely decided to ignore.
It's so weird. But the main hook here, the indices rebounded, and they did it almost entirely powered by chip stocks, and surprisingly, some pretty solid bank results.
Well, it's a classic case, isn't it? The foundational stocks, the big ones, they set the tone for the entire market. When the biggest players in the infrastructure game commit massive funds, investors they follow. It doesn't matter what's happening in the Red Sea or, the Arctic.
Okay, let's unpack this. We have to start with the source of all that conviction, the AI juggernaut.
Yeah, and that story, as it so often does, begins in Taiwan.
With the world's most critical semiconductor manufacturer, TSMC, the reports we pulled from CNBC show their earnings just delivered a colossal lift to the entire market.
It wasn't just a lift for the chip sector.
No, it was for the entire AI investment narrative.
And they didn't just meet expectations. They blew them out of the water.
What were the numbers?
In the fourth quarter, TSMC posted a massive 35% year-over-year increase in profit.
35%.
Yeah, setting a fresh company record and just handily beating every single Wall Street estimate out there.
And the detail that was driving all that performance, I thought this was key.
Oh, yeah. The majority of their revenue came from their high-performance computing division, the HPC division.
So this isn't about making, basic mobile phone chips.
Not at all. This segment is all about those highly specialized, high-margin AI and 5G applications. They are, quite literally, the foundation for this AI revolution.
And the analyst community, they reacted with, seemed like genuine surprise.
Genuine surprise and a lot of enthusiasm. We saw quotes saying that TSMC, and I love this phrase, made mincemeat of the skeptics.
I saw that one too.
And the consensus takeaway was that demand is simply insatiable. This confirmed the whole narrative that this AI upcycle is structural. It's not cyclical.
Meaning we are still very, very much in the early innings of this spending boom. And that structural view brings us right to their future plans, which are honestly more important than past performance. We have to decode the capital expenditure signal here.
Yeah.
The CapEx.
Right, because earnings are great, but future spending plans, that tells you everything about a company's long-term conviction.
And this is where the story shifts from just a good quarter to a real market driver.
A massive market driver. TSMC didn't just report good numbers, they issued a CapEx forecast that fundamentally reset expectations for long-term AI confidence.
Give us the numbers just for perspective.
Okay, so they're projecting their capital expenditures will hit somewhere between $52 and $56 billion in 2026.
$56 billion, that's...
Yeah.
How does that compare to what they spent in 2025?
Well, that's the staggering part. It's up from about $40.9 billion in 2025.
So you're talking about a potential 30% plus increase in CapEx in a single year.
At least a 30% increase. And that 2026 number, it's a full 50% higher than the peak we saw in the last cycle back in 2022.
Wow, that is extremely aggressive spending. Now, isn't that dangerously aggressive?
Yeah.
Given that analysts have been worrying about chip demand sustainability for months now, why is the market seeing this as a green light instead of, a warning sign of oversupply?
That is the crucial question. And a JP Morgan analyst, Gokul Hariharan, he addressed exactly that. He noted that this projection reflects a much greater confidence in long-term AI compute.
Okay.
So in his view, TSMC is signaling that it is fully embracing this AI upcycle.
Because their customers are telling them to.
Precisely. They are responding to repeated, firm commitments from customers like NVIDIA and AMD for guaranteed capacity. This isn't speculative spending. It's spending backed by purchase orders.
It also marks a pretty significant transition in the timeline of the whole AI development cycle. That's a subtle point, but a hugely important one.
It is. Wells Fargo analyst Aaron Rakers highlighted this shift.
What did he say?
He observed that the industry is moving away from a heavy AI training investment cycle.
Which is when developers are, building those massive foundation models.
Exactly. Think of it like building the giant power plant. Now they're moving it into the phase where inference is starting to proliferate.
Okay, let's just quickly clarify that distinction for everyone listening.
Sure. So training is building the power plant. Inference is basically turning on the lights in every single house.
Right.
It's the process of using the pre-trained models to generate predictions or answers in real time. And that requires immense specialized computing power distributed everywhere, on your phone, in the cloud, every data center.
And that ongoing high-volume usage is what's really carrying the chip sector now.
That's it. It guarantees those long-term structural revenue streams for TSMC and all its partners.
And the market just reflected that conviction immediately. We saw NVIDIA jump 3%.
Broadcom rose.
AMD got a lift. And crucially, the VanEck Semiconductor ETF, the SMH, it hit a fresh 52-week high.
Meaning investors are treating this as an industry-wide acceleration.
Exactly. Even the chip equipment makers in Europe, like ASML, they climbed because, well, TSMC needs their specialized tools to fulfill these plans.
That supply chain reaction is a perfect illustration of how critical TSMC's position is. They really are the linchpin.
So we've covered the hardware, the chips, the massive CapEx. But that hardware is pretty useless without high-quality fuel, which is the data itself.
Right.
And that transition brings us to the AI data monetization front, where content and knowledge sources are finally trying to control their own destiny.
What's really fascinating here is just the speed at which companies are moving to secure that data pipeline.
Like Cloudflare.
Yeah, Cloudflare, the internet infrastructure company, they made a highly strategic acquisition this week. They bought a UK startup called Human Native.
And they operate an AI data marketplace, right?
They do. And Cloudflare's CEO, Matthew Prince, was very clear about the goal here.
He argued that content creators need both control and the ability to get paid fairly for their work.
Especially when their content is just being, hoovered up to train these large language models, these LLMs. He said the deal is intended to establish a new system where AI developers can purchase reliable, high-quality data through fair and transparent channels.
He actually called it the fourth act of Cloudflare.
He did, which signifies just how strategically vital this is for them. They're betting that brokering these transparent data transactions between creators and the big LLMs is the next frontier of internet infrastructure.
The market wants clean, structured data, not just, general web scrapes.
That's the key. And you see the ultimate example of that with the Wikimedia Foundation.
Right. They announced new enterprise deals with some of the biggest names in AI.
I mean, Amazon, Meta, Microsoft, Mistral AI, Perplexity, the whole list.
All to grant them controlled access to Wikipedia's API, specifically for training their models.
And this is a huge shift. It links right back to the high value of quality data. These AI giants are now paying for API access to the clean, organized, human-curated knowledge that Wikipedia provides.
They're moving away from just relying on scraping the free internet.
A Wikimedia spokesperson basically emphasized that the long-term future of AI depends on nurturing projects like Wikipedia because it creates that reliable human knowledge the models need. They're positioning themselves as an essential, high-quality data utility.
It's the ultimate convergence story. You've got the chips providing the engine.
And then you have players like Wikimedia and Cloudflare trying to control the fuel, that high-quality data, and monetize it for the people who actually created it.
And all of that growth conviction, that massive CapEx spending, it's only possible in an environment where you have at least perceived financial stability.
Exactly.
Which moves us pretty smoothly from tech growth to the bedrock of market confidence,
Right.
the financial stability signals.
And despite all the elevated global risk, the financial sector really provided a surprisingly strong anchor this past week.
We saw better than expected Q4 earnings from the major banks.
Yeah, which reassured investors about overall credit health. Goldman Sachs did well, and Morgan Stanley specifically jumped nearly 6% after their upbeat results.
What was driving that for them?
Fueled in part by a really robust performance in their wealth management unit. But these results, they sent a key risk-off signal to the broader market. The core financial institutions are fundamentally sound.
On top of that, the liquidity signals are just screaming confidence, according to Reuters data.
How so?
Global equity funds logged their largest weekly net purchase in 15 weeks. They drew in a massive $45.59 billion in net investments just in the week ending January 14th.
$45 billion. That is serious institutional money pouring back into the market. It's a real sign of conviction in future growth.
And the main driver for these strong inflows, connecting it all back to the macro picture, is that perceived shift in monetary policy.
Inflation numbers.
Right. The reports confirmed a moderate rise in the core CPI in December, and that solidified expectations for interest rate cuts later this year.
When inflation looks contained, it just clears the path for the Fed to ease up, which makes all those riskier bets on CapEx and tech growth look much more appealing.
And the market is voting with its money. The most popular sectors for those heavy inflows were tech, industrials, and metals and mining.
So it's a very clear signal that investors are prioritizing growth over being defensive right now.
And that momentum is strong enough that it's currently managing to overcome some pretty substantial geopolitical headwinds.
Which is where we turn next: geopolitics, commodities, and yields.
Let's start with a really complex situation in the oil market involving Venezuela. CNBC reported that the U.S. completed its first sale of Venezuelan oil.
Valued at about $500 million, and this was following the seizure of assets related to the former Maduro regime.
The striking detail here is the claim by the U.S. Energy Secretary Chris Wright.
What did he say?
He stated that the U.S. is securing a 30% higher realized price per barrel compared to what Venezuela itself was getting just 3 weeks prior.
Wow. And this is a highly strategic sale. President Trump noted the proceeds would be controlled by him to benefit both the U.S. and the Venezuelan people.
But this is where the geopolitical move bumps right into a massive investment hurdle.
The $100 billion pledge.
Exactly. President Trump pledged $100 billion in investment to rebuild Venezuela's crippled energy sector. But Exxon's CEO, Darren Woods, essentially told him the market remains uninvestable.
And that's because of the past seizures of assets, right? Like theirs and Conoco's back in 2007.
That's the crux of the issue. How do you convince these major multinational energy companies to invest $100 billion when there's no guarantee that a future regime won't just expropriate those assets all over again?
That history is a tremendous impediment to Trump's pledge. The political stability has to come before the financial investment.
And separately, we saw other geopolitical friction points. Oil prices initially slid after President Trump delayed imposing tariffs and backed off potential attacks on Iran,
which eased a major source of near-term risk.
But then tensions flared up in the Arctic. Several NATO nations deployed troops to Greenland for joint exercises.
Following those strained talks over the U.S. proposal to acquire Greenland, so these high-level security issues are always just simmering under the surface.
And yet, despite all of this risk, Iran, Greenland, Venezuela, the U.S. Treasury market has been, according to Bloomberg, exhibiting record low volatility.
It's been so quiet. The 10-year yield has held in this remarkably narrow range, between 4.1 and 4.2% since mid-December.
There's the longest stretch of bond market inertia we've seen since 2020.
It is.
Which seems totally counterintuitive. Why is the bond market so calm when there's so much risk swirling? Even domestic stuff like the Justice Department's actions against Fed Chair Jerome Powell.
Well, this raises a really important point of investor anxiety. That level of prolonged inertia, that stillness, it often precedes a pretty violent move.
So it's the calm before the storm.
It could be. BMO capital markets strategist Ian Lingen observed that previous instances of these constricted yield ranges have often been followed by a sharp sell-off.
So the calm is reflecting entrenched expectations for steady U.S. monetary policy.
But it's potentially hiding all this underlying unpriced risk. Inflation could rebound, or one of these geopolitical situations could suddenly matter a whole lot more.
That is a great transition to our final segment, where politics and market volatility meet right in the courts. The AI legal showdown.
And this major development comes straight from Bloomberg, OpenAI, and Microsoft. They failed this week in their request to escape trial in that high-profile lawsuit filed by Elon Musk.
So a federal judge in Oakland rejected their motion to dismiss. This is going forward.
It's going forward. The trial is now set for April. and it centers on Musk's central claim that OpenAI betrayed its founding mission.
It was established as a public charity, but when it pivoted to a for-profit entity and partnered with Microsoft, Musk says it violated that original agreement.
Right. He argues his seed contribution, which sources put at $38 million, was attached to the specific condition that OpenAI remain open source and nonprofit.
This is about more than just money, then. It's a battle over the ethical, the philosophical soul of AI development.
It absolutely is, especially when you consider OpenAI's nonprofit arm is now linked to a for-profit entity that's potentially valued at $500 billion.
So if the court agrees with Musk, it could fundamentally redefine what open source even means for companies that make that kind of transition.
A huge precedent. OpenAI's defense, according to the court filings, is highly aggressive. They're calling the lawsuit baseless harassment.
And they said it's worth no more than the $38 million that Elon donated.
Yeah. They also anticipate he'll make deliberately outlandish, attention-grabbing claims as the trial gets closer.
The legal scrutiny here is going to be intense. This is about corporate governance under a massive spotlight.
For sure.
So what does this all mean for you, the listener? The primary takeaway this week is really the extraordinary market confidence reflected by those massive AI hardware CapEx plans from TSMC.
That's what's enabling this strong organic growth.
And that growth is being supported by a critical shift toward data monetization. You see that in the strategic moves from Cloudflare and Wikimedia, trying to control that high-quality content supply chain. And all of this is happening against a backdrop of surprisingly resilient financial markets, stabilized by strong bank earnings and moderating CPI data.
Which all reinforces those expectations for rate cuts, allowing this aggressive CapEx cycle to really take hold.
Right.
But as you consider that stability, you also have to consider the potential risks where finance and politics intertwine.
Like President Trump's personal financial holdings.
Exactly. He has purchased at least $51 million worth of corporate and municipal bonds. We're talking about debt from companies directly affected by his policies, like Netflix and Boeing, which is a major government contractor.
And he hasn't divested these assets, which is unlike many previous high-level officials.
So the question to think about is this. How will this continued non-divestiture, even if it's managed by others, impact the perception of market integrity and the neutrality of governmental policy, especially when those very companies are subject to high-level regulatory decisions or government contracts?
That ethical tension point, it just continues to simmer right beneath that veneer of market calm. A compelling question to leave you with, indeed. That's the deep dive for the week.
A lot to chew on.
We'll see you all Monday morning with new headlines from major financial magazines.